In terms of why it is a good time to be investing in a minimum volatility strategy, maybe I take a step back and kind of describe what minimum volatility strategy means. So specifically, as of end of last year, the iShares platform, we launched a suite of 4 minimum volatility strategy ETFs. And by minimum volatility strategy, basically what we do is that we take the parent equity index and we apply a factor-based MSCI Barra model optimization in order to extract a minimum volatility index that look and feel just like the parent index but has a lower forward-looking volatility, i.e. risk. And it is really built for investors that look to stay within the equity market, but are very much aware of the uncertainties ahead, given political risk, given economical recovery risk, as I'm sure all of you are. So in terms of why volatility is something to kind of pay close attention to, before I go into the current environment, I want to differentiate and make a distinction between volatility and risk. So currently, we're in this very curious environment where the volatility across multi-assets, and especially within the developed market, is at all-year lows. If you look at the VIX index, the VIX index, which is a measure of the implied volatility for S&P 500 in the US, is currently around 13, which is really at a very low level compared to historical averages. However, it clearly does not tie in with the heightened political risk and the uncertainties around economical recovery. So we're proposing that the actual measure of volatility, i.e. Such as the VIX and such as standard deviation of return, is not a good measure of the system risk that is in the market, and instead to accurately gauge how much risk to expect from financial market, it is perhaps more accurate to look at political risk index, for which there is actually an index on Bloomberg, as well as to look at where the market is trading, i.e. where the equity index are with respect to the fundamental economy, and see if there is an apparent dislocation between the two. So to kind of put that into context, I guess Europe is a very, very good example to show why these two can deviate from each other. So very recently, European equities was making all multi-year highs, which is really impressive, especially given the fact that there is no fundamental growth and there is a lot of political uncertainty. Oh, did I just speak a lot louder?
Avete sentito? Si sentiva abbastanza bene, in ogni caso.
Okay, and it's really surprising on the surface of things, because if you look at the fact that there's no growth driving the market, why is the equity hitting multi-year high? So we looked into it, and there are mainly 2 reasons that is kind of pumping up the market. The first one is the implicit promise by Mr. Draghi from ECB to almost guarantee liquidity to the market if it was called for. And the second reason that the European market is performing so well is because of its correlation with the US market, and that is doing relatively better. So basically, it's the US that is dragging up the European market. But if you analyze these 2 reasons for why European equity is performing so well, you realize that one is political promise, one is sentiment, and none of it is tied to fundamentals. And that is why it is important to kind of look at minimum volatility strategy, even if the market seems to be performing well, because it is not a normal, healthy, trending market. It is a market that is pumped up by sentiment. So to kind of validate that last point, we looked at some performance analysis between European equity rally versus US equity rally for the quarter that is finished at the end of March. And interestingly, in Europe, the rally, even though it was quite impressive, it was mainly led by defensive names, whereas in the US, it's led by cyclical names. So you really see that it is being dragged up rather than it was organically rally within within itself. So looking forward into the second quarter, we are kind of expecting a softer quarter, both in terms of the data that is coming out, as well as in terms of the political risk. So if in the first quarter, minimum volatility have been performing well, going into the second quarter, even more reason for us to be assessing these investment tools, because it seems to be providing a very attractive investment opportunity. So the 4 products that iShares have recently launched, by recently I'm talking about end of last year, covers the MSCI World, MSCI Emerging Markets, MSCI Europe and US. So it's quite granular. You can almost kind of play it and plug in your existing portfolio quite easily. So that is why it's a good time to be looking at this.
È interessante vedere la performance rispetto agli altri indici, per questo le domande che da porre sono appunto riguardano questo, e poi soprattutto il ruolo all'interno di un portafoglio. One of the things, when I want to be aggressive, I can use these minimum volatility strategies, but is it useful for defensive approach or not? And how did it work in the recent time respect to other indexes?
Absolutely, that's a good question. Actually, intuitively, if we look at minimum volatility strategy, you would almost associate that with defensive play, given the fact that it looked to minimize forward risk as calculated by basically the MSCI Barra portfolio optimization tool. So you would actually associate defensive to minimum volatility rather than cyclical. However, the difference between the suite of minimum volatility products that iShares has put out versus some of the other similar low-risk strategies out there is that we aim to create a product that look and feel just like the parent index. So in addition to minimizing the forward-looking risk, we also try to keep, for example, the country exposure, the sector exposure, very similar to the parent index, just so in almost all other aspects it's similar to the parent index, but it just has a lower volatility. So not surprisingly, from backtested results and also some of the life histories, the minimum volatility strategy provides a more risk-enhanced return compared to the parent index. And given the fact that we have the index that is very similar to the parent index, it's very easy for investors to just take the minimum volatility product and add to their existing portfolio or replace the parent index and still have a similar country and sector exposure, but with a lower forward-looking risk.
But it works?
Yes, it works, absolutely works. So back to performance, your question on performance. So year to date, minimum volatility strategy has actually outperformed the parent index. And this is really interesting because year to date we have had a relatively good rally, especially in the US and definitely also in Europe. So in the US, the minimum volatility strategy for the exposure has outperformed the parent index by about 2%, and in Europe it has outperformed by about 3%, and for the emerging market and the world strategy, the outperformance is around 5%, which is quite impressive, especially given that it was in the trending up market and also its defensive tilt. So it really looked to kind of break the myth that that minimum volatility is only a low beta play, because if you say that, you forget the positive quality and upward skill that the strategy also brings. So if you look at historically back-tested result, it does have a low beta, but it also seems to have a slight positive alpha compared to the parent index, which explains the outperformance year to date, as well as the outperformance since the inception of the index. And earlier on, Mark, when we were speaking, you mentioned that some of the investors are very cautious about approaching the alternative strategy and alternative index or portfolio strategies. So I would just like to mention that the construction of the minimum volatility index is very transparent in the sense that it is 100% rule-based. So how all the factors are, what are the factors that are considered, and what are the forecast volatility, what is the country and the sector misweight and constraint, and all this process is clearly stated in the rule book. So you can, if you have the setup with spreadsheets or computer, you can literally recreate this index. So there's no black box. It's you can find exactly how to replicate it. And in terms of the portfolio constituents, given the fact that we wrap it using the ETF instrument, we publish the constituents of the fund holdings on a daily basis. So that is something a bit reassuring, especially for alternative investors that often have to wait until the end of the quarter to see what is in their portfolio. You can literally see what was in your portfolio the day before. So that is also something that is interesting.